And we're live. We're live on Facebook, live on Zoom. Welcome, everybody. Welcome to our attendees coming in wherever you are. It's really good to have you here. If we haven't come across each other yet, my name is Marie. I'm the TFF Community Manager and Entrepreneurship Leader, and I'll be leading today's session. We're just going to give a few people time to join in case they're running a few minutes behind. I would hate for them to miss the introductions to our amazing panel. But for now, of course, welcome. You can already tell us who you are. If you're here already, we'd love to hear from you. So feel free to, in the chat, tell us who you are, what you do, and where in the world you're joining us from. It's always nice to see the international audience that TFF brings to these events and where in the world they are, and seeing if we can match this with our speakers as well and get loads of continents all in one room together. So feel free to let us know where you're joining us. And also when you do that, just change your settings so you're messaging all panelists and all attendees so that you can see each other's messages as well. So hi, Christine from Switzerland already, from the Netherlands, and I'm sure we'll get a few more, someone from India. India. There you go, Mark is in India too. So welcome to all of you. What we'll also have is time for questions. And so throughout the session, we like to hear from you what your ideas are, what your thoughts are, but also, of course, if you've got questions, ideally, you can use the Q&A function at the bottom of your screen to drop those questions in, and we'll pick them up at the end of the session. Otherwise, you can also do them, put them in the chat, and I'll make sure to pick those up. And if there is anything that we've missed today that you think, oh, we really needed to tackle that, you can also drop us an email afterwards. But hopefully this will demystify VC funding for you. So that is what today's session is all about, VC funding 101. So we'll try to tackle everything there is to know about VC funding, from the outrage all the way to successfully obtaining funding from a venture capital firm. We're joined by three amazing speakers, different parts of the world, different companies. We'll dive into a little bit of what they're doing, but then also how as a startup you can approach them and how you can ensure that you get that money that you need to take your solution forward. So again, if you just joined us, I'll be leading today's session. My name is Marie Bruiser. I'm the TFF Community Manager and Entrepreneurship Leader. And I'm really excited for today's session because we get so many questions about this process, about how to find funding, how to take our idea to the next level, and how to really make it out there in the world of all these startups. And so today, what we're hoping to do is to demystify all of that a little bit. I'm joined by three fantastic speakers. So let's have you all please introduce yourselves and your company briefly. As well, where in the world you are as well, because we do have different continents represented. So I'm joining from Croatia today. Ariadne, over to you.
Thank you, Marie. Very nice to be here with everybody around the world. My name is Ariadne Caballero. I am part of SP Ventures. I'm partner on this firm, and we are the largest agri-tech food base, specifically in Latam. We have around 12 years of experience. We started as a generalist in the south of Brazil. We invest around 8 companies in the beginning, and 50% of those companies in the early beginning were from agri-tech. So that's where we thought that it was very interesting for us to really focus on agriculture. And I've been here for the last 2 years. I have a background specifically in industrial engineer, and 12 years experience in agriculture. I started my career working as working in agribusiness as well. And since 10 years ago, we haven't looked back. We're totally focused on funding and looking for entrepreneurs and trying to support them, really changing the way that we do food and agribusiness all over the world.
Perfect. We'll dive into that a little bit more about the type of projects you work with, but really great to have you. Dalal, it's a pleasure to have you here as well. Could you please also tell us a little bit more about who you are and how you got to where you are today?
Thank you so much, Marie, and thanks for inviting us over. So hi, everyone. My name is Dalal AlGhawas. I'm the Program Director for Big Idea Ventures, representing Singapore. So Big Idea Ventures, we're kind of a newcomer. We were established in April 2019, but that doesn't really mean that we haven't let's say picked up speed and made a lot of traction. So we're really proud to say that we've launched 3 funds. We've successfully closed one of those funds, which is the New Protein Fund. We're backed by very strategic partners, and of course this is very valuable for our portfolio companies, because they can really help them spearhead and accelerate their business as well as grow like successfully. So some of our partners include governments, large food corporates, as well as chemical industries. And these are really, put into place to help our companies, let's say, navigate through the regulatory, let's say, pathways to be able to introduce novel food items, to the specific region that they want to expand in. We also work with, upstream and downstream, let's say, corporates that are helping with food processing as well as ingredient sourcing. And then, because we look at like a very interesting mandate, which is, food technology. Our first fund, is really focused on alternative proteins, which encompasses, plant-based as well as fermentation and cell-based. So some of those processes will involve a lot of biotechnology, which is why we do partner with like companies such as Buehler, as well as Noru Holdings, which is traditionally an agrochemical company. So, with these strategic partnerships, of course, they can support our companies to understand what their pain points or challenges are with scaling up, and adequately sort of build out that infrastructure so that they can, let's say, plug into that system once they've reached the right stage of funding, of company growth, and then that will help them with their overall expansion. So, for us, we are, let's say, focused on alternative proteins, but we have expanded into other food categories, especially in the more late stage investments focused at food processing and mitigating, let's say, the waste streams such as, water efficiency, energy efficiency, as well as reducing plastic wastes in the food production system. And last but not least, we try to go through a very early stage, let's say, investment vehicle where we target, let's say, research institutes and academia, and really conduct like a venture building exercise to commercialize research and make sure that they can become viable businesses. So yeah, we're very excited because we get to work with global companies, but of course get to plug them into our very different offices, which is New York for the North American market, Singapore for Asia Pacific, and recently now we've launched in Paris so that we can also encompass Central Europe as well.
Perfect, thank you. Nice to hear that you have the whole globe covered now as well, so that's great to hear. Mark, what does Omnivore do, and what do you do for them?
So Omnivore funds entrepreneurs in India building the future of agriculture and food systems. We are not a new kid on the block. We are about a decade old at this point. So we were one of the first agri-tech firms, dedicated agri-tech firms to ever get launched, and definitely the first in Asia. It's been a great 10 years. We helped to catalyze the agri-tech ecosystem in India, which is now moving on at a very fast clip. And it's probably a bit helpful for everyone here to understand, a lot of times we get this question, why do you just focus on India? To which I usually respond, because 1/6 of humanity keeps me busy. India is one of the world's largest agricultural ecosystems. We have 130 million farmers, top 3 in practically every commodity that counts. Number 2 in rice, number 2 in wheat, number 1 in cotton, 2 in sugar, 1 in milk, 1 in pulses, 3 in beef, which always surprises people because it's from water buffaloes. A huge producer of practically everything in the world, and one of the most complicated agricultural ecosystems, because in addition to these 130 million farmers, they have their families, and this amounts to about half of the population of India. And so we are part of a transformation that has really started to accelerate over the last few years. We look at really trying to identify startups that are solving the critical challenges faced by Indian agriculture. We see that as kind of fourfold. Number one, farmer profitability. Number two, farmer resilience. Number three, agricultural sustainability. And finally, climate action. And we see India as very much a proxy for smallholder farmers globally. So while India has 130 million farmers, almost all of whom are smallholders, the world has 500 million smallholder farmers. And we see India as probably the best laboratory for smallholder agriculture in the world, because unlike many smallholder countries, which bluntly have a lot of smallholders and not much else, what India has is a smallholder ecosystem that coexists with an industrial economy, that coexists with one of the most dynamic startup and venture ecosystems in the world. And so we are seeing agri-tech startups being able to raise and scale and innovate with incredible human capital and go after solving these challenges in India, but also pursuing challenges outside of India as well, tackling challenges across smallholder agriculture globally. So that's us. Otherwise, from a nitty-gritty perspective, my background is basically agribusiness. I've lived in India for 14 years. I used to help run one of India's largest diversified agribusiness companies, and before that, I worked at Syngenta. So my career has been in this space. I'm kind of an accidental VC. Most of my team is the same. At Omnivore, we don't have a lot of people who are former investment bankers or former investment professionals or anyone from McKinsey. What we have are a lot of people who come from the agribusiness industry, who have run dairy companies, who have run tractor manufacturers. And so that's really our USP. That's what gives us the right to play in this space. And it's the reason why people take money from Omnivore, because in addition to the capital, we really do understand how to scale businesses in ag. So I co-founded this with a guy named Janesh Shah. There are now more than a dozen of us, offices across Mumbai, Bangalore, Delhi, and Chennai. And we always remain interested in what's happening outside of India as well. We have started to be able to have a bit of flexibility to do things outside of India, not fully yet, but we're getting there. So looking forward to hopefully helping people to navigate the process of VC.
Perfect, thank you. You make a very compelling case for being just in India. Maybe we'll stay with you then. So you mentioned a little bit about your coworkers and the backgrounds of them. Let's move over to the ventures that you end up backing. So what stages do you typically invest in, or is there even a typical? Are you across the scale, across the board? And how does that reflect to the applicants you get? So do you get a lot of early stage applications, but in fact you put most of your money into later ones? How does that look like?
Who are we starting with? Me?
Yeah, let's start with you, Mark.
Okay. So we are a very classic early stage investor. And by that, I mean, we're not an accelerator. We don't do pre-seed. We very explicitly don't do pre-seed. But we do seed. We do what's commonly known as a pre-A, and we do Series A rounds. Those are the stages that we would look at entering at. There might be a weird circumstance where we could come in a Series B, but historically we haven't really done that. We've come into like pre-Series B bridge rounds, would be kind of the latest that we would be coming in for the first time. Our typical entry check is, I would say on average, about 1.5 million in a seed round, in an institutional seed round. And if it's a pre-A, going up to a Series A, we might come in with anywhere up to about a $4 million check, but we can also go down as far as about 500K. So anything in that range, we have quite a bit of flexibility. For us, it's really about the traction of the company relative to the stage, right? What we look for at a seed is very different from what we look for at a pre-A and what we look for at a Series A.
Perfect, thank you. Dalal, this is coming your way. So you're going to get the same question, but I will, and hopefully this is okay, just because this is VC 101. Could you also explain to us pre-seed, seed A, seed B, just to make sure that we're all on the same page? Sorry, I know I didn't give you any warning on this, but that would be great.
No problem. No, it's no problem. We're constantly doing this with our portfolio and potential and prospective, let's say, companies that we want to work with. So typically, first I'll start off, with the definitions, right? So pre-seed would usually be, a company that is receiving their first institutional check or their first institutional investor. Typically, a pre-seed round would be anywhere from, let's say, 250,000 up to $1 million. It really depends on the category as well as how innovative that company is. And to be honest, even when it comes to fundraising nowadays in the sector that I'm focused on in alternative proteins, it's quite insane. So I really can't benchmark certain figures. They keep changing every day. And then, when you look at seed rounds, that will typically be, the stage right after. So that will be around 1 million up to actually 20 million. So there was one company this year that raised a 20 million seed round, which was insane. But again, typically I would say a seed round can be 1 million to 5 million. That's more reasonable, but you never know what might happen. And then, of course, for your seed, your Series A round, or even the pre-Series A round, the build-up for that would be anywhere from, let's say, 5 million up to 20 million for that Series A, pre-Series A, just to give everyone some context. So for Big Idea Ventures, what we do is we do focus on pre-seed. And I'll tell you why. It's really because, I would say that the ecosystem is so new. And to be honest, like a lot of companies, I would say that they do need a lot of support in terms of, really validating the technology because they are so novel. At the same time, when we start to look at companies that are a bit later, let's say they're looking for their seed round or pre-series A round, usually the valuation just doesn't fit. I think, there's a lot of hype with alternative proteins, but it's very difficult to kind of screen through it. So what we prefer to do is to work with companies at the pre-seed round. We work with them through an extensive due diligence process, which lasts around 5 months. And basically throughout that period, we monitor them, we observe them as a company, and we support them with, through the accelerator model to help them with their business development, with fundraising, product development, distribution, sales, whatever they need. So at the end of that, let's say, extended 5-month due diligence period, we can then decide whether we want to top up our investment. And typically we won't be the lead investor for the second round, but we'll be a follow-on, depending if they can secure other interested investors. So we can invest up to 3 million in anywhere from seed to pre-series A. That's for the new protein fund. But for our other funds, like the Generation Food Fund, as well as the Rural Partners Fund, then of course it's a very different story. And for the Generation Food Fund, we can invest in companies like from Series B and above. These are much bigger check sizes. But this is a brand new fund, so I can't give you the metrics right now. But yeah, in general, I would say that the majority of our portfolio does consist of pre-seed companies. And I'm really happy to say that at least 50% of them have already raised their seed round. So I think this model is working for us, especially so that we are able to attract very innovative companies and monitor their growth and traction throughout.
Perfect, thank you, and great definition as well. Just to set the scene, it will of course vary a little bit on where you are and what you do, but it helps set the scene for a lot of our early stage entrepreneurs here. Ariadne, finally over to you. Tell us a little bit more about your setup and your portfolio.
So very quick, guys. We are totally focused on Latin America, but not necessarily that we invest only in entrepreneurs from Latin America. We are also one of the funds that we invest in companies that want to come to Latam as one of our strategic region, and that is, we understand that Latam is a key region for different companies. It depends, of course, on the technology. There's a catch, right? Considering tropical agribusiness versus other type of agricultures. So we have to be mindful of that. But once the entrepreneurs have a compelling story and they really want to enter into LATAM, that's where we look into that space. We raised recently a fund of $50 million. The focus was, we were previously Brazil only, and now with this fund, we're covering LATAM. But I had to say that COVID hit in the beginning of 2020. So this new scenario has proven to be very challenging, right? Considering talking to new entrepreneurs, you have to understand that Latin America is a huge region, right? There are definitely differences from Mexico to Brazil to Argentina. So we understand that the ecosystems have different maturity from region to region. So if you look at and you do a zoom in specifically on Brazil and Argentina, they're of course, very mature into agri-tech. And we're looking at this time of very more, solutions that go across the full change of agribusiness, which is very interesting. And if you see, for example, Mexico and up there, definitely agribusiness, agri-tech, and specifically is something that is still in their early stages. But if we see food, I mean, we've seen as well as Dalal comment, I mean, we've seen crazy seed valuations and things happening and moving. So it's very exciting at this time. So we're really focused on LATAM, but with different approaches, right? Specifically for us, we are the same, Mark. I mean, traditional early stage fund. We focus on from seed to Series C, and sometimes, I mean, we follow our companies to Series B, but we like to definitely lead those first institutional rounds. We understand that this is an important valuation, right, from the company. So besides of having a fantastic team, right, many of the VCs will understand that part of the weight of our saying yes or no, it resides on the team and also on the traction, but also how does the teams approach to VCs as well. So for example, we are looking at this time, I mean, three different funds, totally focused. So it's important for the entrepreneurs to do the basic homework on who target, right? Because sometimes we get pitches or messages from founders that are not necessarily within our scope. And it is a first impression that we get. I mean, if you get into the site of any fund, sometimes it will tell you, it could be that. So try to reach out and do this previous homework. It is really important.
Perfect, thanks for that. And I think that is on the mind of a lot of entrepreneurs. So I'm sure people in the audience will have been excited about what you've just said and thought, oh, I want to join that. So I hear from your answer already, make sure that you do your research in advance, make sure you approach the right person with the right company. Mark, I see you're agreeing with that as well. But what if I am the right person, you're the right person or the right company? How do I find then the right person to reach out? Is it the website, general email address? Is it through connections? Is it on LinkedIn? How should startups approach this?
I think in general, so I really liked what Ariadne said, which is, please read the damn website, okay? Like, I get prop tech deals, I get, I get ad tech, meaning advertising technology. And the best part is that people get belligerent when I don't respond, right? It's like a cold message in LinkedIn. I don't respond because it's like, some sort of makeup application app, right? And then the person like 2 days later is like in all caps being like, why don't you respond? And I'm just like, I generally, in all caps, read my goddamn website, right? I do ag in India. That's all I do, really, that's it. And so I think it's important to make sure that whoever you're chatting with, you understand that you fit into their universe, right? There's no reason, if you're looking for a growth round, right? You're looking to raise a $30 million Series B or Series C, I'm probably not the person for that, right? Similarly, if you are looking for 200K, right? And you should be in an accelerator, I'm also not the person for that. I think in general, with respect to how you approach a fund, it really depends. I definitely do answer cold messages out of nowhere on LinkedIn because I think it's important to be accessible. But the level of attention that I pay to them is less than if there's a warm introduction. So I think wherever possible, use your network to get an introduction to someone. And I've heard other VCs be really harsh about that and just be like, if you don't have the skill to figure out a connection to network with me, you have no business raising $2 million. Like, if you can't figure out how to do that, just stop right now. So we're not that harsh. And so, if you approach us directly, LinkedIn is not the best way to do it. A networked intro is far better. The other point is, you have to remember that funds are at least a little bit hierarchical, right? So if you want to do the LinkedIn thing and you don't have a connect, hit the associate on LinkedIn, right? Their job is to do that first filter, and you shouldn't feel bad about that or that it's some sort of huge time waste, right? In general, the associates, the principals, they know what the partners want to see, and their job is to make sure that the partners see things that are relevant for the fund. So yeah, there's a filtering process going on there, but it's also easier to get that first meeting. Those would be my suggestions. It's about doing your research. It's ideally about getting a networked connect. And if you don't have that, then approaching the right level of the fund and being okay working your way through that process.
Plenty of truth and advice in there. Dalal, anything to add on to this or things that you've seen?
Yeah, absolutely. And I totally agree with Mark. I think it would save a lot of time if, people did do their research and check, what our, let's say, sweet spot is before they, let's say, started communications. But, what I would say that, if they want to, like, how to kind of build up that process to get a referral, it's quite straightforward. And this is what we tell a lot of, prospective startups is try to join a network, join a community. There are actually a lot of VC firms that we work with, including Cocoon Capital, that do VC mentoring. So like VC office hours. And I think right now there's like a very strong mandate to support like women in entrepreneurship. So there are a lot of these, women think tank VC hours where you get to speak with different, investors, and they can give you, let's say, feedback on your pitch, as well as introductions to, potential investors. So I think, just making sure that you're active in the community, that you're going to conferences, exhibitions, just speaking to as many people as possible. And when you do see that door opening or someone who's receptive, just ask them, bluntly, can you introduce me to so-and-so? Can you introduce me to someone in your network? Just be bold and, don't be shy and outgoing to make sure that you get those introductions. I would say, as well that, you need to do your research, but also be very clear what you want. And at the same time, be open-minded. So something that, we often struggle with, with our, let's say, accelerator model is a lot of companies will tell us, oh, we're too late stage for an accelerator. But we try to explain to them that, we are not your typical accelerator in the sense that we are comprised of, let's say, industry experts. So everyone on our team comes with a food background or, let's say, experience in the F&B industry, either with product development, distribution, sales, or even fundraising, especially, some of our managing partners are one of the most seasoned food tech investors in the space. So I think, it's important to really understand who is on the team in the VC, to understand their caliber, their background first, before you make that, judgment and assessment. And I can say this very confidently because unfortunately, accelerators are not regulated in many countries. I know, like, especially, you know, I'm from the Middle East. You know, in MENA, there is a huge problem with a lot of, let's say, VCs or even accelerators popping up that don't get screened by any government body, that operate as, you know, let's say WeWork spaces, but they take equity from startups and really prey on vulnerable people. So I think it's very important to really understand, like, you know, number one, like, are these accelerators accredited? And, you know, luckily for Big Idea Ventures, we are accredited by the Singaporean government. And, you know, on top of that as well is understand who is backing that fund, right? So like, if that fund is not backed by strategic partners or is not backed by, let's say, government or food companies, then don't expect so much from them, right? Maybe it's just capital, maybe it's just an angel investment, etc. But, you know, if you are looking to really specialize and if you really need help with upscaling and introducing a new technology into the world, make sure that you really understand and really screen that investment firm. You know, as much as we do our due diligence, do your due diligence on us as well.
Perfect, thank you. And what I want to add to that, that actually in this whole network and that first stamp and showing that you have something that works and that first step into this world can be TFF, right? So a lot of you in the audience will have probably joined the TFF challenge. This is your chance to connect with our global network, put in your pitch by Friday. That can be the first step of coming into this, of making these connections. That's why we're here. We do that first step. If you're early stage, if you're still working on your prototype, we can work with you, we can support you, we can connect you to mentors who can already tell you a little bit more like today, but then you get to ask them questions directly. And finally, eventually, when you're ready, you will find the right VC, if that's in your path, connect with them, and then you can already have that network there. So just by being here today, you're in a great place already. And we have heard that actually, that final point, Dalal, we've heard that from startups who just, from our portfolio, who've just raised money, who said, well, one thing we didn't understand at the beginning was that VCs weren't going to swoop in and save us. We're the ones offering them something, and we need to do that due diligence on them. We need to see if they fit for us, because we have something we're doing, we have something new that we're working on. We want that backing, but we're the opportunity for them. So I think as a startup, it's also having that perspective, which I think is difficult because of course you need the money as well. But I think it will change how you approach others. Another thing we've heard from a startup who has raised millions was that at the beginning, when they were quite early stage, raising their first rounds, you always have to put in this 5-year plan. Right, and so also for the TFF challenge, you have to lay out your 5-year plan. And of course, as an early stage startup, that seems odd. You don't even know if you're still going to be around in 6 months. How are you meant to plan for 5 years? So from your perspective, then, what is it you look for, or what do you want to see in that 5-year plan, or, you know, in this projections? Because I think it would be nice for an entrepreneur to understand what lens you're using to look through this. Mark, you're unmuted. Let's start off with you.
No, so I don't actually care much about projections. I always like to say, let's not start off our relationship by lying to each other. You know, projections are generally garbage in, garbage out. You don't know, I don't know. It's really hard to know. We don't spend a lot of time looking at them. I used to do, back when business plans were more of a thing, like a decade ago, I used to do this little guest lecture at one of the Indian business schools where I would take a typical business plan, and it was like 3 pages of text and 9 pages of projections. And then I would shred the projections, throw them up in the air as confetti and say, you wasted your time here. Like, I don't think that's generally important. And we don't give much stock to them. We always kind of look at 4 things. And I think what we look at is exceedingly basic, and kind of everyone also does the same. So the first thing is we look at team. Team is the most important thing in an early stage startup. It's also the thing that will oftentimes really surprise entrepreneurs, right? We'll be like, you're great, go get a co-founder. Right? And then we'll have this like horrified engineer who has no idea how to sell anything being like, how could you possibly ask me to get a co-founder? That's why. And it's like, because you have no commercial skills, but getting someone to join my business, like, that's hard. And it's like, and you want me to give you $2 million? You can't recruit a single co-founder. You can't get someone who knows how to sell to join you, and you think you're going to sell me. Like, so team is huge. You know, I think the second thing is obviously this term that gets batted around called TAM. TAM is total addressable market. All we're trying to make sure when VCs play the TAM game is that we're not in a niche lifestyle business that's too small for our asset class. The thing you have to remember about venture capital is a product. It is a financial product. Everyone has a master that they serve. The master that the VC serves is the LP, the limited partner. What do those people want? They are large institutional pools of money, and they want more money. And the VC is a very small part of their strategy, right? Think about a giant pension fund. What does a pension fund do? Well, they put a bunch of money in fixed income, they put a bunch of money in public equities, and they put some amount of money in real estate and hard assets, and some amount of money in what they call alternative assets and private capital. Private capital is not just venture capital, it's also private equity, it's large leverage buyouts. So VC is typically, for their LP, 2% of the capital deployment, sometimes 3, if we're lucky, 4. We're a very small part of a big pool of money. And the reason why someone puts money into a venture capital fund, if they're a giant freaking Canadian pension fund, is because they think they can get very outsized returns, right? So unlike, you know, investing in public equities where you can get 7% a year, 6% a year, they're really trying to get high double digits out of a VC fund. What does that mean? It means the stuff that we invest in has to be able to deliver outsized returns. And what does that mean? It means it can't be niche. It can't be small, right? And it has to be suitable for taking venture capital. This is one of the great challenges is I'm constantly pitched with stuff that's like perfectly good ideas, right? It's like, I want to set up a factory to process jackfruit. Cool. That's great. Please don't take venture capital for that. Like, I want something that does a 10x return, and you're never going to do, like, you need a bank loan, dude. And then people are like, no, but it's hard to get a bank loan. And I was like, I know, but that's the right financial product for what you're building, right? So number 1, team. Number 2, TAM. Number 3, tech. Tech is self-explanatory. We want to see something that's differentiated. We want to see something ideally with some IP protection. And finally, traction. And traction is relative, right? I care about all of that stuff more than I care about financial projections. The only thing that I really care about with respect to financial projections is your understanding of your unit economics. Do you understand your LTV? Do you understand your CAC, long-term value, cost of customer acquisition? Do you understand the margin structure of what you're doing? Do you have a sense of how you could become profitable? I don't care about your 5-year. I will ask you eventually to build a 5-year projection. We might even help you with it. Because I think it's oftentimes, you know, no one knows how to do it really well. But all of that other stuff is much more important. Sorry, I talked too long.
No, the 4 T's, I like it. Ariadne.
I wanted to add definitely what the Mark says is very, very important. Sometimes we look into the financials, right? Only to kind of like measure how big the dream is, right? But every company has to come with their North Star. What are the KPIs that you're measuring, and how do you know you're having success? Because sometimes we understand that, okay, what are the KPIs that a startup has to know? This. Sometimes you are going to come up with new KPIs, and understanding those KPIs, it's part of your responsibility to really communicate them correctly, that your success has been measured through this lens, right? The North Stars are very, very important, and definitely KPIs on financial. Every business plan changes, right? It's just a way for you to communicate, I mean, how big the market it is, and definitely there are many other ways to target those. And to Mark's point, I really want to go back. It is important to understand, why do you need VC money, right? This question, I mean, this point is really relevant, because we've seen many companies, fantastic companies, that are not necessarily raising VC money, and it's fine. It is just a different way of doing business. VC, sometimes we get into distraction that it's startup. VC, we want everybody to fit into the same box, and sometimes it is impossible. And sometimes even the incentives from the founders are not there. So it's important for an entrepreneur to come with a very clear understanding of what is expected from VC. You'll get fantastic things, but sometimes it doesn't necessarily fit with what you want from your company. And that is very important to really start analyzing. If VC is your way to go, do your homework, set your dream, set your team, and go for it. But it is important that you understand the rules.
Yeah, and I would just add, again, I agree with both Mark and Ariadne. I agree with all of their sentiments. And I think it's difficult for us to assess, let's say, a 5-year plan that would fit everyone. And I'll give you like an example of some of the companies that we work with in the cellular agriculture domain. So a lot of these companies, they don't even know when they're going to get sort of regulatory market approval to become commercial or to sell their products commercially. So for them, it's about a waiting game. And in the meantime, of course, they rely on VC money to keep themselves afloat. And throughout each round, they just show progresses in terms of their technology, the innovation. And right now, even with this industry itself, a lot of the companies are just starting to get into pilot scale production. So not even, let's say, upscale manufacturing, but just pilot scale. And something that when we look at the sector as well is that the majority of funding for the cellular agricultural space is VC money, followed by like angels, followed by CVCs, like corporate venture capitals, and then government players. So it's very tricky because a lot of these companies actually require money from corporate venture capitals and governments because they're going to build out the infrastructure where they're going to operate. So everything from the equipment, the biomaterials, the whole supply chain. So as VCs, what we try to position ourselves is we are backing, let's say, innovative technologies, innovative companies that otherwise would not be able to receive that bank loan, as Mark mentioned, that it's too risky. No one can really let's say foresee or kind of predict the future. But with venture capital, we are not so risk averse, right? We are comfortable because at the end of the day, our analogy is 90% of startups fail. So we don't mind risk. It's okay for us. But of course, we want to make sure that we can de-risk our investments by making sure that we really understand industry trends, that we can, let's say, influence policy change, we can educate corporates, we can educate governments, and hopefully create a pathway for our companies to succeed.
Perfect. Thank you. Great answers from all of you. And I will, in a minute, take answers from the Q&A, so keep them coming in. But before we do that, and Ariadne, you already touched on this, how does working with a VC firm differ from some of the other funding or some of the other streams that you could go down to? Can you kind of outline that a little bit and what the process and the resulting deal of working with a VC looks like for a startup as well?
Yeah, no, definitely. And what I was saying is sometimes you have entrepreneurs that treat their companies as their babies. These are their babies, and definitely are, right? And these companies, they want this to be kind of like their legacy and transmit it to their kids, and that is fantastic. It's just not necessarily a VC play. So once you know exactly the incentives that you are in, the incentives that the VC have, at the end of the day, Mark pointed out very well, we're an industry, right? And we need to get returns for our investors as well. So we are here, skin in the game with you, same. We are in the same boat, but definitely there's a process, right? And once you get into the VC trouble or the VC journey, let's say, you're going to get diluted from round to round. So sometimes it is interesting to talk with some entrepreneurs, like, but how should I balance this? I think that is part of the rules that you need to learn. You're going to come. You're going to be joined by different partners as well, right? In the VCs and support and mechanisms to growth. That is fantastic. But there is a price in doing that. Definitely doing it together. An entrepreneur journey, it's very lonely, right? So doing it with people that you like, that you respect, that you understand, and this is where the due diligence again from the fund that you're going to join or the partnership that you're receiving, it is such an important and so critical. And again, when we say do your homework, it is important because VC fund is going to take you from one way to another, right? You need that money specifically. So the VC and a specific, each firm, it's very different. And it really has to be attached to your objectives, to the culture that you're trying to build in your company. So these decisions are so important. So definitely it is a game changer for a company to really jump into the VC journey.
Perfect, thank you. We have a lot of questions, but Mark and Dalal, do you want to build on that? I think a lot of that was.
I thought that was great, but I'm happy to go hack away at some of the questions so people get their specific concerns resolved.
Perfect. Well, Mark, let's start with you. There's a request for a book to understand what we've discussed today nicely. So it's coming to Mark, but I think all three of you, if you have any book recommendations or basics for, you know,
I can't say there are any books that I necessarily like absolutely love. I think there's some really good books that entrepreneurs should read, right? Like Ben Horowitz's book is a great book about like just how many near-death experiences a startup can go through before realizing what approximates success, right? So I think a lot of people read that. I think the hard thing about hard things is a good read generally. It's kind of typical Valley perspective, but I think it's kind of stood the test of time. You know, I hate to say there's not like a great book. I would point you to a lot of blogs because I think they're frankly a bit more relevant. Fred Wilson's AVC has some really good stuff. It used to be more of it because I think that stuff became more common knowledge. But there was some really rich information there back in the day that's still probably very relevant. Brad Feld has put a lot of stuff out there over the years, including his book Venture Deals, which is probably the best book to read to understand how not to get, I won't even say screwed in a term sheet, how to just understand like what you're negotiating when you're doing a deal. So I think that's pretty useful. I would point to some other people. Mark Suster from Upfront writes really good stuff. But there's just a ton of stuff in Twitter and in other formats that I think is really helpful and useful for entrepreneurs that was not there. That's really built over the last decade. And I think that's going to be probably more relevant than any book. Overall books on like the VC ecosystem, I would say if you want to understand the other side of the table, those can be that can be kind of useful, which is like what VC is, what life as a VC is like. So you get the other side of the transaction. But yeah, that would be kind of my advice. But I'd be really keen to hear what other resources people have.
Yeah,
I would just chime in. So like definitely, you know, getting to understand the perspective from companies and their own stories and how they've sort of, you know, navigated the VC landscape. You can like listen to podcasts. There's a really great podcast called How I Built This, which interviews, you know, different founders and kind of ask them about their journey. Something that, you know, I encourage all of our portfolios companies to do, and this is something that we actively do for them, is actually just do a case study on your own. So if there's a specific company or sector that you're very curious about, like how they've succeeded and like who's invested in them, how much they've raised, you can learn a lot. And just by looking at like, you know, data from PitchBook or Crunchbase or you name it, and different articles, you can start to bridge together different pieces and understand like what their journey has been. And of course, always pick like a very successful company and assess, different pathways. So some companies go through acquisition, some of them go through the IPO route, others just continue to, let's say, raise different series all the way up to F and above. So assess, what's happening. And it's also, really important for you to understand your own sector. That way, when you are negotiating your term sheet, you really understand what the valuations are, you understand what the hype is, and you can also learn some of the pitfalls that those companies have faced. And I would say even when it comes to, let's say, fundraising, there's all kinds of, let's say, ways, right? In terms of the rounds, the pre-rounds, you also have crowdfunding now, which is becoming more increasingly popular. So I think just by doing those case studies, it will open your mind to a lot of different concepts. And then you can rely on books to supplement some of those terms to really understand what they mean.
Yeah, I agree. Definitely books and podcasts are great, and you have enough, right? Enough information there, many information that can be useful. I really recommend to reach out to other founders to really understand. They have been there, they understand. I mean, many of them successfully, some of them probably not successfully. So you can really benefit of hearing their stories, understanding their points of view. And I think in the entrepreneur world, everybody's kind of like open really to share what are their learnings, what are the challenges, the missteps that happen. So really reach out to your network for other founders and learn from them. It's very important.
Perfect. Thank you all. So all those resources will go into the write-up of the session, so you'll find them on the TFF Digital Lab soon. And also at TFF, what we do, we have case studies on some of the startups, and we can connect you to them as well. Often, like Ariadne just say, they're more than happy to share their experiences. And also, I think sometimes in the media, you only see the positive stories, right? It sounds like they've been on this smooth path up ever since they had this idea. That is not the reality. Yeah. So do check in with them and find out, the ups and downs, because it's not just you going through. And I think that's inadvertently you answered one of the questions, I think, from Charles from Uganda, who said he's tried to get funding. He's been told he's asked for too much money for too little money. And why does this happen? So I think, Charles, what you just heard, find maybe a company that does a similar thing as you, see how they've raised money, how they've gone on their way. Find the right person to approach as well to make sure that they fit what you're doing, to be the right investor. But maybe there is a question here on how do you evaluate your own company? Is there a trick for this? Is there a website that will do it for you?
No, not really.
Yep, that's what I figured, but you never know.
Yeah, but, I mean, the point, like I'm looking at Charles's message, and my reaction would be like, it seems like he wants to do like cashew processing. And the thing that I would ask him is that a startup or is that an SME, a small and medium-sized enterprise? Because if it's a startup, great, but it doesn't sound like it. It sounds like he's trying to build a processing SME, which is terrific. But then VC is absolutely the wrong asset class for that.
There you go.
That's I could be wrong. I could be absolutely wrong, and maybe he has some intense, some different perspective in terms of how to build this. But like I said, I've seen too many times where people are essentially saying, you can need money to start a restaurant, but a restaurant is not a startup, right? You can need money to start a small manufacturing unit. That is also not a startup. They are both SMEs, and they are both hard to finance, and they both need a little bit of equity. So someone's saying the difference between a startup and an SME. The difference between all startups start out as SMEs. An SME is just a new business that's just getting started, right? The difference is a startup generally has kind of three characteristics. One is they are iterating their way into a business model that allows for explosive growth, right? Like that's the biggest thing. The second thing is that in general, in order to achieve that explosive growth, they have to do quite a bit of fundraising, right, on a regular basis to overcome, right, the level of investment and the level of scale to realize success. And they do that through equity. So you can build really nice SMEs. And in some cases, the outcomes of SMEs for the founders are even better than in startups, where at the end of the day, the founder owns like 3%. But they're just different things.
Perfect, thank you. And Charles, apply to the TFF challenge. We can have a look at your idea, connect each other, so do that. We don't have much time, so I'm going to ask you for like really quick answers to see how many we can get through. But the next question here is, so first up, amazing insights from Jesse. So regarding deal flow and business development, what part do third-party services play in the F&A VC process? Does the VC leverage external partners, for example, to ensure and optimize deal flow and post-investment business development? Big question. Let's see how quickly we can get that answered.
So do they mean like third-party logistics, or what are they talking about exactly? Or if that's for sourcing deal flow?
Do they mean, do we like using bankers?
I assume it's, or well, the way I saw it is bringing in other investors was what I was thinking of. But perhaps you can tell us more about that, or Ariadne, do you?
I don't know if the comment. Go, Mark.
So someone's asking, like, if a broker approaches me, or a banker approaches me, or a financial advisor approaches me with a deal versus a founder, I am like 50% less interested if a third party is approaching me that like is getting a fee for trying to close a deal.
Yeah.
All right.
That's final answer. I mean, definitely when we see companies that use support, I mean, we want to know the team, we want to know really who is executing. We want to know what are the modes, right? The differentiators from this team. So once you introduce kind of like a third party in the conversation, it really plays, I mean, the company has to be really, really, really fantastic for us to get excited. But I suggest to avoid it at all costs.
Thank you. So then we have a question around, and Dalal, maybe you can take this one, even though it's not quite your field, but you mentioned already regulation coming in. And so this is someone working on a deep tech robotic solution, I believe, with drones in India, in crop protection. And the reason I picked you, Dalal, is that there are some regulatory barriers there, and they would need some policy changes within government for them to be able to fully take up this solution as they've thought of it. Can VCs be the place to get funding, but also should the startup work with regulatory authorities to kind of push this forward? And they might need to then show some results from some research, but obviously that takes money as well. So how do you tackle this?
Yeah, well, first of all, I'd say yes and yes. So I'll give you an example about what we do. So like basically like throughout our accelerator program and our extensive support, we do help our companies, get access to regulatory, let's say, legal advisors. We also make sure that they do sign up with think tanks or advocacy groups that are lobbying for policy change. We do that a lot for, of course, the alternative protein ecosystem. But again, you can find, let's say, the right legal and regulatory clients to support you. And on top of that, that's why you should always ask, your VC or your accelerator what they can do to support you. Is we also actively engage academia to commission research projects to help, generate IP or shared IP with our portfolio. So you can do both, and I would say big idea ventures and other VCs are becoming more specialized to do so. And you have to start early. So especially that you are, let's say, bearing the brunt of, let's say, pushing this technology forward, that you're very knowledgeable in this sector. You have to start forming your own union, or let's say, we call it like a syndicate, to make sure that you can lobby similar companies or similar industries to really push policies and kind of raise awareness and education to your policymakers.
Perfect, thank you. I am really conscious of time, so we have run out of time. We have a few more questions, but we might get back to you via email if that, or Mark, I feel like your motion is like I can answer them quickly.
I'm going to answer the crop protection India one quickly, which is my suggestion is to go and build what you want to build, but pilot outside of India, because as I have joked in the past, we will back a crop protection drone company when the Home Minister of India is spraying his lawn from a drone. And before that happens, we won't. Because in general, the process has been 1 step forward, 30 steps back, 2 steps forward, 20 steps back on drones in India. And it's been an absolute nightmare. And my suggestion would be, like, go get your engineers and go to Indonesia, Vietnam, Sri Lanka, or some other country that is more drone friendly. Like, that's the best advice I can give you. I cannot tell you that, like, going and hacking away at this problem in India actually makes sense until you have a regulator that is more friendly.
All right, great advice there. So it is the end of the session. Great questions from the audience. Thank you for joining in, but also amazing insights here from the three of you. So thank you to you. Just real quickly, this is of course part of the TFF challenge, and tomorrow we're tackling one specific topic that we're looking solutions in, and that is our resilient restaurant track. So join Eric Parkin, who's the digital business leader at Cargill, who's going to tell you exactly what they're looking for. And so they're also investing in solutions in this space. There is a prize at the end of this, monetary prize and a direct in with Cargill if you win it. So if you're in that field, join us Thursday at 1 p.m. UTC for that. But of course, the big thing is submit your pitch to the TFF challenge by Friday, the 28th of May. That's when the deadline is. And then you'll get a chance to just have everything opened up, have new connections. You might become a TFF finalist. You might win one of the topical tracks. But most importantly, you're part of the TFF ecosystem. We work with you together. We connect you where we can. And who knows, maybe one day Ariadne, Dalal, or Mark will be your VC. But thank you to the three of you. Thank you to the attendees, and hope to see you soon.
Thanks, everyone.
Thank you.
Bye, guys. Thank you.
Bye.
Take care. Bye.